Hello everybody, my name's Corey Kramer. Welcome to the Cyclical Investors Club YouTube channel. I've had a lot of questions recently why I don't use the mean reversion function on fast graphs. So I use fast graphs in almost every single video that I do, and I utilize fast graphs a lot. I have a link down in the description if you would like to get 25% off fast graphs. Try that link. But I think it's just like every tool, you shouldn't feel obligated to use all the features that are there. You really want to use the ones that are useful to you in your particular strategy. Now, so what I'm about to talk about isn't like a fast graphs issue. It's about a bigger issue about how you want to use it, and what's appropriate to use at different times. I know a lot of people that watch my videos will notice that I use things I use it as a tool for my own analysis my own style of analysis that I do. So the bigger picture is, now I used to use mean reversion as part of my process. So I would do like an earnings valuation, and then I would have a mean reversion valuation, and I would put the two together, and that would give me kind of an overall estimate of what I thought the returns could be. Now, since it's been almost a year now, basically, I switched to only using an earnings-based valuation and getting rid of the mean reversion assumption. And the reason that I did that is the main reason is because of interest rates. Interest rates have gone up a lot. They were at 0% for a long time. Now, a lot of standard analysis will take like the 10-year treasury yield, use that as like a discount rate or a hurdle for expected investment returns in stocks. I don't exactly do that, but typically the lower interest rates are, the lower alternative investment returns are in bonds and other investments, the lower stock price valuations will be. If you just think of it as like an earnings yield from a business, you think of that as maybe similar to like a bond yield. So bond yields go down, the prices of stocks can go up because that lowers the earnings yield. Basically, investors are willing to accept a lower earnings yield when bond yields are lower, which means the stock prices, the stock valuations will be higher, all other things being equal. Well, that means when interest rates are very low, stock prices can be higher than normal. We had a period for over 10 years where interest rates were very low from 2008 until last year, like 2 years ago, like 2022. So 12 years or 13 years of very low or zero interest rates means that when you do a mean reversion for a stock based on a PE, which is the earnings yield, using this period, it's probably too high. Or at least you probably shouldn't assume that now the interest rates are higher, that a stock, all other things being equal, will revert to that previous PE mean, right? So Coca-Cola I picked as an example because it's basically the exact same business it's been for the past 20 years. And I'm going to try to explain beyond what I just explained why this is really, I think it's really important. I mean, I changed my whole investment strategy, or a big part of it, because of this, because I used to use mean reversion and I thought, look, that looks pretty dangerous to keep using if interest rates stay high, but like our high now is normal pretty much. I mean, it might come down like another point, like another percentage point, but usually interest rates are kind of where they are now, and the unusual period was actually the period from 2009 to 2022. So that means that all other things being equal, you would expect stock valuations to come down because you have an alternative where you can put your money and get higher yields. Like you can get 5% now basically in cash. That's a lot more than zero, So there's another place where people can put money. They don't have to pay a lot for future earnings of businesses, okay? Or as much as they used to, unless those interest rates come way back down again, so. But I'm kind of taking the long-term average when I think about this, or at least the risk, right? The risk to me seems to be that stock prices don't revert to mean, like don't even come close, probably go the opposite direction, which is what I'm going to talk about here. So I'm using the blue line here that people keep asking me about in the fast graph, which is the normal, like they call it the normal PE ratio, which is the average PE ratio over this time period. I started in, so we're going like 20 years. I went 2014, and then we project a little bit here in 2024. So if you put your little cursor here, I think if you click this, that's the average PE. So if the stock goes to the average PE and earnings growth grows 4%, which is what is expected this year, the stock would trade at $65.56 a share, which is $4 more, we'll call it, than it is right now. So on a mean reversion basis, it looks like, all other things being equal, you should earn a little bit of money this year if Coca-Cola stock reverts to its mean over the past 10 years. Okay, so that is a pretty high mean. What I want to point out here, before I move really quick, is they've only been growing earnings at 2.77%. So a PEG ratio, it was popularized by Peter Lynch. At least that's where I first read about it. It is they might even have it on fast graphs. I thought they did for a while. Let me peek real quick. Okay, I don't see it. It might be here somewhere, but I don't see it right away. So it's the earnings growth rate divided into the PE ratio. Okay, so if you divide this earnings growth rate into the PE ratio, the average PE ratio, right? So this is the earnings growth rate and the average PE ratio during this time. You get 8.42 in my notes here. That might have been through 2023 instead of 2024, but basically we'll call it an 8.5 or 8 PE. Okay. Typically, stocks historically trade at a PEG ratio of like 1 is considered like a good value usually. So you imagine a business growing earnings at 10%, trading at a 10 PE. Back in Peter Lynch days, that would be a buy. So that would be cheap. Okay, normal valuation for a PEG ratio might be 2. So the lower the PEG, the better, the more attractive the stock is, right? So you imagine a business growing earnings at 10%, trading at a 20 PE. That's a 2. That's okay. Like you think of that as maybe like a hold. If you go up to all the way to 3, think of business growing earnings at 5%, trading at a 15 PE, which is kind of the long-term market average. That would be a PEG ratio of 3. 5 goes into 3, or 5 goes into 15 3 times, right? That's usually not attractive. Like that's the level where you can pretty clearly, assuming all the other assumptions are right, that's not attractive. So the average PE compared to the earnings growth over this time period for Coca-Cola has been over 8. I mean, crazy high compared to really any kind of rational valuation, unless earnings interest rates, are like 0. And then it kind of makes sense. It's like, well, if you get, let's say, well, this is like, what's the earnings yield? Like if you get 4% and it grows at the rate of inflation, well, that's better than getting 0 or 1% or whatever from bonds. Like you can legitimately make that case when the yields on other investments are very low, which is what they were. So it's not that people were necessarily crazy for paying that much for Coke in those conditions, but those conditions have changed. Now, how long they'll change, I don't know, but I don't want to make the assumption that people are going to be willing to pay that much for Coca-Cola's earnings when we know already interest rates have already changed. So I think people that still own Coca-Cola are either making a big mistake or they need to have like a recession or something happen where the stability of Coke's business kind of makes it make sense. All right. So if we go back now, I'm going to go back in time. You can adjust that on here to the 10 years leading up to this. The 10 years leading up to this, we can see what Coca-Cola was trading at back here. Okay. Now, during this time, Coca-Cola grew earnings nearly 8%. And the PE ratio average during this time was lower. It was actually 19.5. So they're looking at a PEG ratio of 2.48 in my notes here, assuming I set the right dates up. That is kind of normal. Like, that's normal for a good brand, you know, growing earnings at a decent rate, that everybody knows that's pretty stable in recessions, right? I mean, so 2.5 PEG seems okay. Like, that doesn't seem unreasonable. And so this is what it used to trade at during this previous 10-year period. And now it's like quadruple. So what I want to do is, like, what would happen if Coca-Cola actually traded at the old PEG ratio, right, of like 2.48%. Or sorry, 2.48. It's not a percentage, it's just a number. Well, you can figure that out if you just take the earnings growth rate and multiply it by 2.48. You get a PE ratio of a 6.87. So if Coca-Cola was trading, including earnings growth and their average PE from the first decade that we have here, it would trade at a current PE of 6.8. It's trading 4 times higher than that. Now, okay, that's based on kind of this previous 10 years. If we just look at what they expect to do this year, which Wall Street likes to do, they like to be very short-term oriented rather than look at the history. So they're expecting 4%. Okay, so if you got 4% earnings growth and you continue that, that would be a PE of 9.92. All right. Coca-Cola's, that's the average. It's actually a little bit lower. So Coca-Cola's trading at 22.5, which is almost 23. But that's more than double if they actually get this earnings growth, what it used to do before interest rates were at zero. Actually, interest rates were at zero for a short period of that time. But before the 0%, it just embedded itself into the market. So what you have here's the upshot. A person who's just looking at the mean reversion will say, oh, I have a chance to make, let's see, 8% or something the rest of this year in Coca-Cola if it just reverts to the mean. And maybe I'll get lucky and it goes even a little bit higher and I get 10%. Okay? If you're doing this, that seems rational. But the reality is, if rationality truly set in order to go from a 22 PE down to like a 10, which is what's here, this stock needs to fall like in between 50 and 60%. So you think you're going to get 8%, and instead you get 50% loss. If that's just the main thing that you're focusing on, is the mean reversion. Okay, so that's why I don't currently use the mean reversion. If we get to the point in the future where it becomes rational to use it more again, I might reintegrate it back in, because there are some stocks where market sentiment actually plays a role in the price movement that's not necessarily connected directly with near-term earnings. And in those situations, mean reversion can be really useful to get you extra returns. But right now, I mean, if you ask me, like, it's much more rational, given Coca-Cola's growth rate, to trade, 40 or 50% lower than it is right now, assuming interest rates stay somewhere near where they are right now. So hopefully that helps explain, and I'm happy to answer any questions in the comments section. But hopefully that explains why you don't see me using the mean reversion, except for maybe in special situations where I'm trying to show something. And I hope that maybe I can keep other investors maybe out of a little trouble by, if they're making these kind of other assumptions, just to at least think about what I talked about, and consider it. Okay. Thanks a lot, everybody. If you found this useful, hit the subscribe button. I'm going to put this in my kind of learning to invest playlist with some other videos. So because I think it will just be useful kind of all the time. See everybody later. Bye.